Let's go now to our friend Beimnet Abibi from Galaxy Digital Trading. As always, great to have you here.
Thanks for having me.
How's it going?
You know, it's going. It's going. The markets have kind of turned a little bit recently. It's been off the back of really exceptionally strong like U.S. data, PPI, employment stuff, and you've also had some pretty hawkish Fed speak, although it's not new. So you've had a repricing in the rate market, and that's kind of caused equities to take a little bit of a break.
Yep.
And I think it's totally reasonable. Taking a step back, I think, what has driven a lot of price action this year in many markets has been an incredible degree of short covering, whether it was in crypto or EM equities or, non-profitable tech that had been beaten up. So what you've had happen to start the year is sort of a massive repricing of risk assets as folks got stopped out of things. And to give you an idea, looking at like some PB data that we follow, one bank reported it was like they had 12 consecutive days of just like insane short covering. It was like one of the longest periods of like that in their entire history that they kept track of the data. So you had a lot of short covering, and we knew that in crypto at least there was, $500 million in liquidations on both of those times that, crypto really popped off.
Yeah.
So a lot of the price action this year has been driven by short covering. And then you got to a point last week where you had a really aggressive rate move. And so once the short covering is done, you really need marginal buyers to kind of support that market and every market. And at least in traditional markets, equities kind of lacked that marginal buyer in a meaningful way, because as we mentioned earlier, a lot of that buying was driven by short covering and then a little bit of FOMO chasing.
So it's been drifting a little lower over the last week. It's been drifting a little lower. Yeah.
And I think that speaks to kind of, one of the points, I hope we touch on later, which is, like excess liquidity in the market. And I think people totally have a misunderstanding of what that means in today's context, because the difference between, excess funds in a 0% interest rate environment and excess liquidity in a 5% interest rate environment is tremendous, right? And one, you don't get paid to sleep at night. In another, you get paid quite well to sleep super comfortably. And so what that means is every time that a marginal dollar gets deployed in risk asset, it's at the cost of 5% overnight rates.
Right.
And so even if you have $100 billion of excess liquidity in the market, that $100 billion is earning 5% plus at no risk.
Yeah.
And so I get it, when people talk about, there's still tons of cash in the market's awash, people still trying to buy stuff. But don't forget, we're in a 5%, overnight interest rate environment. And that's fundamentally different than...
You're not hunting for yield.
You're not forced to go out the risk curve. It used to be that, fixed income investors, to get any yield, would have to go so far out the curve. You got to take risk 7, 10-year duration. Well, now, overnight duration gets you much better yield than that 10-year paper.
It's crazy.
And so it is wild, and I think people have a complete misunderstanding of that construct. And what does that mean in actuality? It means that people don't feel like they have to buy the dip in stocks.
Yeah.
There's no urgency.
Yeah.
Or at least the institutional investor doesn't.
So I think one of the reasons you bring this up too is that there have been some headlines about some central banks that have been injecting more liquidity.
Absolutely.
And I think people on Twitter have been misinterpreting that.
No, absolutely.
What were those?
There's a difference between, actually buying assets in the open market and providing financing for them. So, for example, the PBOC, they reverse repo in assets. They provide short-term lending versus an asset. And so somebody gets cash versus securities, but it's not really a sale and their balance sheet isn't really going up. A lot of those funds tend to stick in the financial plumbing or the banking system, within their respective economy. Japan being another example, where, they're doing all these, emergency bond purchases, and, that money is really, it's not going past the Japanese banking system
Right. So it doesn't
in a
filter
way.
out in a way that it can support risk assets, for example.
It's less direct
Yeah.
than people are thinking.
Yeah.
Versus like when the Fed was buying $4 billion of treasuries and mortgage-backed assets, like, no, that was a big deal.
Yeah, that was directly in the market.
That was directly in,
Right.
in the market. But they were also doing it by providing all these financing lines and facilities, etc. But yeah, it's a different paradigm now, and I think people are, constantly misinterpreting it because nobody is used to the idea of higher interest rates.
I mean, when was the last time rates were this high? I mean, like decades, right?
Well,
do we even get this high?
2000.
Did we get that high in 2000? How high did we?
Yeah.
Okay.
Yeah. In
But
the
it's okay.
early
20
2000s.
years though.
But it's been a while.
Yeah.
It's been a while. But it's also the idea of higher for longer.
Right.
Right.
And that's when you said that the markets are repricing the rates market. That's what they're seeing. That Fed speak, that hawkish Fed speak last week has resulted in, I think we were looking at it, right? They had been pricing, and the market had been pricing in some cuts by the end of the year.
Yeah, you had about 70 basis points of repricing of cuts.
So we went from cutting 50 to even still rising and additional.
I don't have it off the top of my head, but
yeah,
it was more like cutting 130, and you went to
and now it's flat.
Closer to 60 or 50
okay.
or
Yeah,
along
so
those
again, higher for longer is being further priced in now. Yeah.
Yes. And the reason for it, I mean, Bullard explained it, this morning on CNBC. I mean, it's you have risks of inflation taking off again.
That is what they don't want.
They
don't want the 70s to happen where it's
correct.
They raise, then they lower, then inflation happens, they have to raise again.
And then when you think about it in the context of the employment market, basically the employment market's telling you can do whatever you want.
We can bear more hikes.
We can bear more hikes. So why not do it?
Yeah.
Right?
We've talked about
you're
this.
not putting the real
economy.
You can always cut. But you're not really putting the labor market at risk by jacking up rates.
Not yet.
They
can go higher.
They can.
They're
and
being
so
told.
it's just a risk reward decision that the Fed is making. At the same time, you can see housing inventories are up, the interest rate sensitive parts of the economy are reacting appropriately.
Yeah.
And there are always unintended consequences to huge monetary policy changes and big ones. And so, I definitely think that while I appreciate Bullard's argument that you're not really risking much by jacking up rates really high,
something could happen.
Something could easily happen. And you just have to think it's not a month of high rates will crack the market, but 6 months of really high rates, a year of really high rates, we
just don't know yet. But you've said this before too, when rates are at zero, you've got no more tools in your tool belt if you have to stimulate the economy, right? But if rates are at 5, you can cut them back, right? So it's go high when you can, knowing that if shit starts to break, you can then pull back because you have all this airspace below you.
Yeah.
And that seems to be the calculus right now, right?
That is the calculus.
It can bear more, so why not do it? And then we'll pull back if we have to.
No, absolutely. But it's just I keep trying to think about what the end game or what the end status of this looks like.
Yeah.
And it's really tough for me to see a scenario where everything's going to shit per se.
Right.
Everything that I'm looking at, it's you understand the inflation problem we have now is it's a good problem to have. The economy is so strong and so robust that it could handle 4 or 5% interest rates while making more people employed, and while people are getting raises, and generally people are feeling good. Gas prices have been coming off. This is a very desirable economy.
The economy is doing pretty well, is what you're saying overall.
It's super well.
Yeah. It's not great for investing necessarily right now, but for working and earning and even saving. Better savers market than it's been in decades.
Correct. And so really, I mean, I had a manager once that, describes it this way, but it's basically central bank policy for the past 3 decades, with the exception of, last year, has been crucifying the savings base.
Right.
But historically, you just you weren't getting compensated to save. It basically led to just a lot more consumption.
Yeah.
Because nobody ever got paid to save. You got paid to invest and putting money in stock markets. But, for your average mom and pop putting money into savings, it's been awful. Now, I'll argue with you that it is still awful.
Okay.
You were talking about, like, somebody was telling me, I actually haven't checked.
Yeah, like the banks aren't passing it through, right?
Exactly. The savings rate, interest rates on most like Mon Pa checking accounts are still like sub 100 basis points.
It's crazy.
Even though they're
Banks
parking it at 4
can,
plus.
Yeah.
So they're collecting a huge interest rate margin. And I think, folks over time will wake up to that.
And demand.
And they will go to Treasury Direct and buy bills, or they'll move to, savings accounts that are much more attractive.
Competition will emerge better.
It will emerge. And like, I'll give you an example. Like, Treasury Direct is one of the most searched things on Investopedia this year.
Yep.
Because everybody's like, oh,
wait a second, I can buy these things right from the government itself. Okay, one more thing I wanted to bring up.
I could go all day.
I know. One more thing I want to bring up before we move on and wrap this up. We were talking about central banks. Augustin Carstens, who is the head of the Bank of International Settlements, the BIS.
Rolls off the tongue.
Yeah, often called the central banker's central bank. He said, there's a headline in Bloomberg
today. Pontification Square?
He said, crypto lost the battle against fiat currency. He says, quote, the battle has been won. Carstens told Bloomberg TV in an interview Wednesday, a technology doesn't make trusted money. And I will just say, when I read this, I first of all, I think of like superhero movies. There's always a supervillain who's prematurely declaring victory. And to me, when I read this, I think, sir, and he's certainly, I think, on economics and monetary stuff, I'm sure he's a lot smarter than I am. But I will say, pretty sure Bitcoin and crypto has not run its course yet.
No, absolutely.
Seems like you're calling the game a little early there, sir.
No, he's definitely calling the game a little bit early now. But, I definitely respect his point of view from the standpoint of, okay, like, what are the key things that crypto is trying to accomplish, right? Like, instant 24 settlement at all times, right? That's something that these central banks can get to.
Yeah,
eventually.
They could do that. They could compete with that.
Oh, absolutely.
Yeah. We know they can't compete with scarcity in the end.
Yes, scarcity.
They will always print more money.
Exactly. I mean, it's literally in the term economics.
Right.
Economics is a study of scarcity, essentially. And so, like, the Bitcoin story, that's not over.
Yeah, he isn't.
By any means.
Yeah.
But could I understand why he's saying that about something like stables? Yes. I mean,
a lot of the world's working on CBDCs.
Absolutely. And it's crazy to think, I mean, the privacy considerations are just
enormous.
So immense.
Enormous.
And money has never, like, been investigated that way, or like tracking people in real time as they spend.
Crazy.
I mean, you have countries that are giving people social scorecards
based on their spending.
Right?
Like, you can have like exploding payments where like if you don't spend it in like 10 days, you lose it. Or if you
it is actually
spend
wild.
it on this, that's you know what, we're going to do a show on CBDCs at some point. So let's table that. But that is a huge issue, and
absolutely.
I'm
and also for anybody that didn't check out last week's podcast with Austin Campbell,
with Austin,
it was unbelievable.
That guy is a genius in the stablecoin world. So,
yes.
Well, Bim, great as always. Great to see you, and
pleasure.
And thanks for coming.